Thanks, everyone. As Eric said, my name is Tim Warman. I'm the CEO of Fiore Gold. Fiore Gold is a relatively new company. It's a gold producer, a Nevada-based gold producer that was formed in September 2017. Pardon my voice, I'm fighting off the remains of a cold. Fiore acquired the assets of a bankrupt mining company that was called Midway Gold. Midway Gold was active in the mid 2000s. They spent about $100 million building a mine in Nevada called the Pan Mine in 2013 and 2014. They began gold production in early 2015 in March, and they filed for bankruptcy in May of 2015. The history of why Midway went bankrupt is a fairly complicated one, but to make it brief, essentially Midway had a lot of debt, a very complicated capital structure, and when they ran into some technical problems as they started up the Pan Mine, they just simply couldn't get out from under that mountain of debt that was hanging over them, and they went bankrupt. So Midway's misfortune was our good fortune. That mine that Midway had built for $100 million in 2014, we purchased it for $5 million from the bankruptcy sale in 2016 and set about correcting the problems that Midway had, the technical problems. We obviously had a lot more flexibility. We had no debt at the time, and we continue to have no debt. So we turned around the Pan Mine, got it operating. It currently produces about 40,000 ounces a year. We've been operating it for 2 years as a run-of-mine operation, which means that we just blast the rock, put it in trucks, put it on the leach pad, and leach it. We've since put in a crushing system, which we expect to give us higher recoveries, so that in the current fiscal year, which began in October for us, we expect to produce somewhere between 45 and 50,000 ounces. Pan is not a particularly big mine, but it's a profitable mine. We've generated operating cash flow from it, we've generated free cash flow from it, and the whole thesis behind the company was that we would use Pan as a springboard to grow the company, and that's what we're doing. And the primary way we're doing that is reinvesting the cash flow from Pan into our Gold Rock property. Gold Rock is a property that's about 8 miles away, about 12 kilometers away, right next door in Nevada. It's fully permitted at a federal level, and that permitting process is a long one in the United States. It took 8 years to permit the Gold Rock property. And now our goal is to put that into production, which would take the company from sort of 45 to 50,000 ounce producer up to a producer with in excess of 100,000 ounces of gold production a year in Nevada. And I'll talk a little bit about these. In the meantime, we would also like to do some consolidation. There are a number of single asset gold producers like ourselves in the US, in some of the surrounding areas, as well as in Canada. And we'd like to merge those together because we think it makes a lot more sense to have a single company with multiple producing assets rather than a whole bunch of single asset companies. Much more efficient and much lower costs. As I said, our assets are primarily in the United States. We have a couple of legacy exploration projects in Chile that we're currently looking to JV. The Pan Mine is a very typical Nevada open pit mine. It's quite simple mining. You can see the drills there, drilling holes that are going to be filled with explosives and blasted later on. You can see from the aerial view of the map of the mine that there are 2 pits, quite imaginatively named the North Pit in the north and the South Pit in the south. We mine from both those pits. We truck the ore to the leach pad, which you can see in the center. We put a cyanide solution on that, leaches the gold out. That cyanide solution then flows into our plant, the ADR plant there, where we strip the gold out of the solution using charcoal. Actually, it's made from coconut shells. And then we produce gold doré that we sell. The mine is primarily a gold producer. I think we produce something like 2% of our doré as silver, but it's primarily just a gold mine. I won't go too much into this slide. It really talks about the things we did to de-risk the project, all the corrections we made, all the fixes we did to get over the problems that Midway had when they started the mine and which ultimately led to their bankruptcy. But basically it involved a lot of drilling to better understand the resource. It involved some changes in the way we mine and stack material on the leach pad, and just a lot of really operational fixes, I guess you could say, that really turned the mine from something that put a company into bankruptcy to something that generates cash flow today. I will say as well that in addition to operating very efficiently, we're also a very safe mine. Pan has been the safest mine in Nevada for the last 4 years running, and we have not had a lost time injury in that time. And safety is always a leading indicator of operational excellence. So we can talk a lot about what we did, but I think the proof is in the pudding here. You'll see gold production over the last several quarters. We've been averaging roughly 10,000 ounces a quarter. We had a bit of a fall off in gold production in our last quarter. That was primarily due to the transition from run of mine over to crushing. We had a few hiccups along the way. I thought it would take 3 or 4 weeks to do. It actually took us 3 or 4 months, but we're now have the crushing system fully up to speed, and we expect that gold production to ramp back up again. All-in sustaining costs on a corporate basis are roughly between $1,000 and $1,100 an ounce, and that includes all of our corporate G&A. And at that kind of cost structure, we've been able to generate between sort of $3 and $4 million a quarter in operating cash flow from Pan. One of the things that impacts our cash flow is the stripping ratio. So the more waste rock we have to move, obviously the lower our cash flow. In general, we're in a slightly higher period of stripping right now. So you can see our operating cash flow came down a bit in the last quarter, and we'll be in a slightly higher strip period for the next quarter or two before we drop back into a stripping ratio that's more typical of the life of mine. So with Pan running well, the main focus there is extending the mine life. It currently has a 4-year mine life. We've been doing a lot of drilling. We're currently drilling on the project now. And our goal is really to add a sort of year or year and a half of mine life each year. So we'll spend roughly $1 million to $1.5 million a year on drilling to continue to extend that mine life. It's a very large property. There are lots of exploration targets there that were generated by the previous owners. You can see them in red there. And those targets have not yet been drilled. So all the drilling that's been done currently has been in and around the mine. In a previous program, we added about 8 months to the mine life. And as I say, we're in a drilling program presently that will continue to extend that mine life. So with Pan running well, our focus has turned to our growth project, which is Gold Rock. Gold Rock, as I said, is about 8 miles away. There's a former producing open pit mine on the site. It was quite a small mine operated in the 1990s by Echo Bay. That mine was operating when gold was running at about $250 an ounce, and it was making money back then. Here you can see the satellite view of the area. You can see Pan up in the northwest there, just south of Highway 50, which is the main east-west highway across this part of Nevada. Gold Rock down to the south. Gold Rock has a resource of about 400,000 ounces in all categories. Interestingly, it's about 60% higher grades than Pan. Sits at about 0.8 grams per ton, whereas Pan is about 0.5 grams per ton. These are relatively low grades, but because they're open pit, relatively shallow projects with heap leaching, they actually can generate decent cash flow. And we expect Gold Rock to be even better. Gold Rock has a lot of exploration potential. That's one of the reasons why Kinross Gold came in as a shareholder. Kinross currently owns about 6% of us. We finished the permitting process for Gold Rock in September of 2018. Interestingly, that permitting process had begun by Midway Gold, and Midway had done all of that permitting process without publishing any technical studies on the project at all other than resource estimates. So they hadn't published a feasibility study, hadn't published a preliminary economic assessment, none of this. So there are really no published economics around what Gold Rock could be or will be. And so to correct that, we've actually begun a preliminary economic assessment, or PEA, and that will be out. We hope to complete it by Christmas, so we'll have the results out early in the new year. And that will give a sense of what are the economics around this, what is the mine life, what kind of gold production can we expect to see out of it. In general, we expect Gold Rock to produce somewhere between 50 and 75,000 ounces of gold per year. That, in combination with the sort of 45 to 50,000 ounces coming out of Pan, would create a mining complex in Nevada producing in excess of 100,000 ounces a year. And we think that we can bring Gold Rock into production fairly quickly and fairly efficiently because of its proximity to Pan. You can see that it's only about 8 miles away. We'll be putting in a road connecting the two, which will take advantage of the existing access road into Pan. The power line for Pan runs about 4 kilometers from the front door of the Gold Rock property. You can see it coming in there from the left as that yellow line. And we will use a lot of the same operating team, the same management team, the same infrastructure. We'll probably just build an open pit mine, leach pads and carbon columns down at the Gold Rock site, and then we'll truck the loaded carbon, that's that coconut shell carbon containing the gold, we'll truck that up to Pan and use the existing refinery, and existing ADR plant at Pan so that we can share that infrastructure between the two. We'll also share the assay lab as well and as much of the other infrastructure as we can. The goal is to have Pan and Gold Rock operating together by the end of 2022. I mentioned we've been doing a lot of drilling at Gold Rock over the last year. In advance of the PEA, we obviously want to grow the resource ahead of this economic study. And the drilling has been very successful. We've hit grades and thicknesses that are very typical of what we see in the resource. And we're quite confident as we go forward that we'll have a larger resource than we currently have on that. But that will come out early in the new year. One other project that we picked up in the Midway transaction called Golden Eagle. This is up in Washington State, up in the northwestern part of the U.S. It's just south of the U.S. border, or sorry, the U.S.-Canada border, near the town of Republic, Washington. Republic was a historical mining district, produced about 4.5 million ounces between 1850 and just recently. In fact, Kinross, again, that name crops up. Kinross is just shutting down the last 2 mines in the area because they've run out of resources. Golden Eagle currently has a resource of 1.74 million ounces at 1.89 grams per ton. That was done back in 2009. It's a historical resource. It was done 2009 using a $750 gold price. If you rerun that same resource at $1,250 gold, as we have done internally, you get about 2.2 million ounces of gold. The biggest problem with this project is that if you were to put an open pit around it to mine it, unfortunately the edges of the pit extend into ground adjacent to us that's controlled by Hecla. Hecla is obviously a much larger company. We've had many, many meetings with them. They've indicated that they are drilling off a sort of 1.5 to 2 million ounce resource right next door on their side of the property. And so we've talked to them about merging the two properties, bringing them together. You could potentially create a 4 million ounce gold deposit in the western US. Hecla, unfortunately, is very, very slow to move. They are a 150-year-old company, and it's like dealing with a 150-year-old man. We are hopeful that we'll get some traction on this. In the meantime, it only costs us $10,000 a year to hold this property. It's entirely ours, and so we can afford to wait, and hopefully Hecla will eventually come to the table. We have a couple of exploration projects in Chile that I mentioned. They're great projects, but we're looking for a home for them because Chile's not really a focus anymore. Fairly simple share structure, 97 million shares outstanding. We have not issued new equity in over 2.5 years. That's because we've been able to fund all of our growth programs, all of our drilling, all of our engineering studies on Gold Rock, and our drilling at Pan, and putting in a crushing circuit at Pan, all from cash flow from Pan, which was our thesis when we began. There are 32 million options and warrants. About 20 million of those are warrants. They're priced at $1.60, so they're well out of the money. We're currently trading around 40 cents Canadian. We had, at our last quarter, $9.7 million US in cash. We had $22 million in working capital and a market capitalization of about $29 million. So you can see that the valuation in the market of the company is really supported entirely by Pan. We're getting no value for Gold Rock, no value for Golden Eagle. And I think with the publication of the PEA in the new year, that's going to change as the market starts to see what the economics are and what the potential is around the Gold Rock project. Valuation slide. All junior mining CEOs are contractually obliged to say they're undervalued, so I'll say that now. We are undervalued relative to our peers. And that's on a lot of very typical metrics. EV per production ounce, EV per resource ounce. There are other companies in that universe that are producing less gold than we are and not profitably and have higher market cap. And so I think one of the things we've been focused on lately in the last kind of 6 months to a year is getting out and doing much more marketing and getting the story out there, because I think we've been flying under the radar for a long time and focused on the technical aspects of the project. So I'll just wrap up with this slide. We do tend to try and underpromise and overdeliver. I hate explaining to people why we didn't achieve the promises we said we were going to do, so I like to keep our promises feasible and achievable. We said we were going to get the Pan mine ramped up and generating cash flow. We did that. We said we were going to extend the mine life through drilling. We did that, and we're in the process of doing that again. We said we were going to get Gold Rock permitted, and we did that. And we would get a crusher installed at Pan to increase gold recoveries, and we did that out of cash flow. Upcoming catalysts, the primary one is going to be continued exploration results and met results from Gold Rock, and that will lead into the PEA, which will come early in the new year. We'll have a Pan resource expansion. Drilling results will be coming out. We're drilling at Pan now. And then in the middle of next year, you'll see a new life of mine plan, a new reserve and resource update. In the meantime, I'm hoping we're going to get some traction on consolidation. There are a number of other single asset producers out there that would make a lot more sense bundled together in a single company, so that instead of 4 50,000 ounce producers, you've got one 200,000 ounce producer. And that growth profile is really our goal at the moment. And I think I'll leave it there. Thank you.
Thank you very much, Kim.